Yes, thank you so much for having me and for letting me to start, the new semester of the Virtual Derivatives workshop. So this is going to be talk about retail structured products. It's titled Salient Attributes and Household Demand for Security Design. And I do know that some of you, especially the organizers, so Neil and Christian and Dima, you have heard the same talk just a week or two ago. So I did add some additional material, but I think I have material for about 35 minutes. So please do ask questions and interrupt me so that we can really chat about the areas of retail structured products that you find interesting. So with that, let me jump to the motivation. If you think about different types of financial engineering, the common goal, the common sort of reason for financial engineering is to improve, or what I call enhance, some kind of desired attributes, some attribute that investors value. To give you a few examples, or what do I mean with this enhancement? For example, pooling and tranching of mortgages into mortgage-backed securities is enhancing safety as it creates safer AA-rated securities out of more risky mortgages. Similarly, portfolio insurance is enhancing safety as it eliminates some of the downside risk. And to give you one example where financial engineering may be enhancing expected return, packaging of equity options into variable annuities is increasing equity exposure compared to fixed annuities, and so therefore plausibly also enhancing expected return. Now, in the rational choice theory, all of this enhancement or engineering would typically only improve welfare as rational investors correctly process all the attributes and maximize utility. However, we have tons of evidence from psychology and also many accounts of financial innovations and cases of financial engineering, which suggest that investors may be overweighting the most salient attributes, so the attributes that are most visibly observed, and they may neglect some other attributes, such as risk. When it comes to the literature, we have a nice series of work by Schleifer and his co-authors. So we have, for example, one theory paper that links this kind of mechanism of salient thinking even to situations where it increases financial fragility and leads to financial crisis. And then we have nice series of work by Bordeaux and Schleifer that formalizes salient thinking and consumer choice, also in the context of financial innovation. However, when it comes to the empirical side of the literature, most of the work is indirect. So again, in the context of mortgage-backed securities, the pricing exercise by Koval, Jurek, and Stafford is consistent with investors overweighting the salient AA ratings and neglect of risk, such as correlation risk. And then the QJ paper by Boris Velle and Claire Sellerier, which focuses on retail structured products, they focus on the supply side, and they find evidence consistent with catering to yield-seeking investors, which could be rationalized with investor salient thinking. Okay, so the missing piece in the literature is really direct empirical quantification, and this is going to be the gap I will try to fill with this paper. Okay, so let me fix ideas at the beginning. Let me show you an example of the security I'm going to be focusing on today. This is an example. This is a payoff diagram of yield enhancement product. So this is one of the most prominent categories of retail structured products, and it's called yield enhancement because the security is enhancing yield compared to the prevailing interest rates by including a short position in a put option in the payoff. And the way these securities are quoted to investors is via two what I call salient attributes or headline rates. This is the headline return. So this would be the coupon rate the security offers, here denoted with a horizontal blue line. So this is also the best case scenario, the expected return in the best case scenario. The second salient attribute, the second headline rate, is called protection level. So this attribute governs the downside risk of the security. And if the price of the underlying asset drops below the protection level, then investors participate in the downside price movement of the underlying. Okay? So these two attributes, I'll call them salient because these are the only two attributes of the payoff that are quantified, and they are also very prominently displayed in the prospectus. The reason I'm focusing on this obscure market for retail structured product is for three reasons. First, it's economically quite important. So as of last year, if you look at the global size of the market measured in terms of outstanding volume, this was $2 trillion. Okay, so it's economically important. Second, there are some important empirical advantages, which, as you will see later today, are very important for my identification strategy. So one important feature of this market is that the attributes of the security, such as the maturity of the product or the underlying asset, or the moneyness, of the security design, they are spanned by listed options. And so I'm going to be using listed options to quantify the markups of the securities and also quantify the impact of the salient and less salient attributes in the design. Another nice feature is that banks in this market offer what I call near identical substitutes. Okay, so in a given month, a given bank may offer a menu of securities which are going to have the same maturity, they are going to be linked to the same underlying, but they will differ in their security design, and they will also differ in these two headline rates they offer to investors. And finally, the third empirical advantage, which I will exploit for identification, is what I call headline rate fixing. So it's a feature of the offering process of these securities when at certain times, these two headline rates are fixed. And I'm going to be using this feature as a falsification test to provide some evidence on the validity of my instrument. The third reason I'm focusing on this area in my work, in my research agenda, is because I believe it's hugely under-researched. So to give you one benchmark where I take the size of the industry and compare it to the size of the academic literature. If you think about hedge funds would be 2 to 4 times larger than retail structured products. And we have more than 100 papers in top journals that use the word hedge funds or hedge funds in the title. When it comes to structured products, retail structured products, we have only 7 papers, okay, of which about half is written by Neil, and I'm also contributing to this literature. The reason this literature is so small and so hugely under-researched is not because there wouldn't be interesting questions, but it's because it's really difficult to get quality data on retail structured products. And even if you do get some data, it's often very tedious to actually work with this market and quantify what are the fees the investors pay. Okay, so the key findings of this paper can be summarized in 2 bullet points. First, on the supply side, compared to the payoff diagram I showed you 2 slides back, I call this payoff diagram plain vanilla because it's the simplest payoff I observe in my data. But for most of the securities, the payoff is not as simple, and banks on top of it add non-standard exotic conditions to enhance both of these headline rates. So to make both the headline return and the protection level more attractive. And the degree of the enhancement using these non-standard conditions is first order in this market. So I quantify that if I fix all the other attributes of the security, these additional conditions increase the headline returns by 11 percentage points in annual return. Okay, so that's a large number. Despite the fact that these additional conditions are super important for what the investors see, what are the displayed headline returns and protection levels, they are largely artificial for the realized returns. Okay, so I quantify that these additional conditions, this degree of enhancement, does not translate into higher expected returns or realized returns. So I call it largely artificial. Despite that, I find that demand is highly elastic with respect to this enhancement, and the economic importance of this channel, this elasticity, is again important. So to give you one number, by increasing enhancement by 1 standard deviation, demand increases by $500,000, which would be equivalent to 20% of the average sales of the product in the market. So I interpret these results as consistent with investors' salient thinking, whereby investors overweight the most salient attributes of the design. So they overweight the headline return and the protection level, and they neglect some other attributes. This may explain why banks enhance both the headline return and the protection level, as well as why demand is elastic. But on top of it, this mechanism can also explain some previously puzzling findings in the literature. So it can explain why, on average, the market for yield enhancement products has negative expected return. Okay, so these expected returns, they are negative because the embedded fees, they wipe out all the equity premia. This is something that has been showed more than a decade ago by Neil and also by my job market paper. So through the lens of salient thinking, you can actually reconcile this puzzling result. On top of it, through the lens of salient thinking, we can also reconcile why about half of the market is statewide dominated by listed options. Okay, so for about half of the securities, investors would be better off just buying or writing 1 or 2 listed options. I also provide some 2 additional results on the mechanism. So I find results which are consistent both with the prominent channel of salient thinking as well as contrast channel. So I find that enhancement increases both in response to disclosure of the less salient features, as well as in lower as well as in response to decrease in interest rates. And so these two results would be consistent both with the prominence, so how displayed are the salient attributes, as well as their contrast to the prevailing interest rate driving the result. So I see a question by Dima. Should I be monitoring the chat, or Neil or Christian, you want to interrupt me when it's a good time to answer questions in chat?
Sorry, Neil
I don't see a question in the chat. Oh, it's a question from Dima in the chat. Sorry. It's a question from Dima. I was doing a bad job monitoring the chat. Sorry. Is there any regulation in the US on how structured products can or cannot be structured?
The payoff shape. No, there is no regulation in the US on the payoff shape. So there is regulation on disclosure. There is regulation on what kind of terms you can use depending on the payoff shape. But there is no regulation that would, for example, limit the number of features, of etc. There was a regulation in Belgium that tried to limit the complexity. So there was some cap on how many features you can add in the payoff diagram. That's the only country where I am aware of a regulation of a payoff.
And while we're asking about market structure, what are the, so is there any obligation for the issuers to maintain a bid throughout the life of the product?
There is not. So these securities are hugely illiquid, so there is no liquid secondary market. You can go ahead and try to sell it before maturity back to the issuer, but that's not an obligation. Okay, so in the US, you don't. You may sometimes see the issuers quoting on daily basis the prices in some countries. I don't see it that often in the US. You can get secondary prices from trades, because for many of the securities, you would see those secondary transactions, of which there are not many recorded in trace.
Thank you.
But they will. So the typical maturity of the security I'm going to be looking at today is around 7 months. Okay, so these are not very long dated securities. So the typical investment behavior would be to buy and hold it until maturity.
And so all of your analysis, when you talk about the embedded fees and whatnot, it's all at issuance.
Correct. It's all at issuance. So if anything, I find that if you try to sell it before maturity, there is a markdown. So that may be an additional cost to the investors if you do need to sell it before maturity. That's an additional cost I'm going to ignore.
Thank you.
Hey there, can I also quickly ask you?
Mm-hmm.
Who is active in that market and how competitive is this market?
Yeah, so it's not hugely competitive. So I observed that I think around 5 banks account for 80% of the market, or number something like that. So in total, I may have like 20 banks, but of those, only a handful of banks are really the most important. So it's probably not a hugely competitive market in that sense. Okay. All right, so let me continue. Just a quick remark on the related literature. I see it contributing to the literature on behavioral inattention. Okay, so the story I have in mind is really behavioral stories with behavioral bias of the investors. The distinction here to other behavioral papers that may exploit inattention to add-on pricing, etc., is that here the distortion comes from security design and not from pricing design. It also connects to series of papers that document reaching for yield, whether for behavioral reasons or for some other frictions. So Becker and Ivashina, people often mention this current working paper by Patrick Augustin. So there is some similarity to these behavioral papers that look at reaching for yield. The distinction here is that I'm looking at a different market. I'm looking at a mechanism that comes from financial engineering of security design. And on top of it, in my context, I don't only observe behavior consistent with reaching for yield, but it's also behavior consistent with some kind of reaching for protection or reaching for safety. Okay, so in my context, investors are really overweighting both the attributes that govern the upside as well as the downside. It connects to the literature on financial innovation and security design. So my story would be supporting the theories of behavioral financial innovation. So here, like optimal security design is not a result of whatever background risk or rational preferences, but it is a result of catering to investors who may be subject to behavioral biases. And obviously, the paper connects to this literature, small literature on structured products. So here are the 7 papers that we have in top journals. My contribution is to identify and quantify the distortion that comes from salient thinking of investors. And there are 3 main innovations that allow me to arrive at the result. First, I'm using first large sample data set that covers all the product attributes. I'm developing a new measure of enhancement, and this also allows me to use a new identification method that is based on cost-based instruments. Okay, so if there are no more questions at this stage, let me show you how exactly do I arrive at the result. I'm going to be using first large sample data that covers all the product attributes. So the data comes from originally from a commercial platform that collects data on retail structured products. However, these securities, they are registered with the SEC. Okay, so they are in EDGAR. So in theory, you could go ahead and download all the prospectuses and pricing supplements from EDGAR and extract all the attributes. Instead, I'm going to be using data from the same source as what Salient and Vale use. So it's a commercial platform that collects attributes of those securities. My main analysis is going to focus on 28,000 securities issued in the US. I will observe all the attributes. What is the underlying? What is the payoff? What is the maturity? And the most important attribute, which is typically missing, is the embedded fee of security or the embedded markup. Okay, so the way these securities are sold is not by showing investors some percentage rate of some ongoing fee the security is charging, as you may have with mutual funds. Instead, investors buy the security for some fixed price, but the fair value of the security is lower than what is the price the investors are paying. And so there's some embedded markup charged by the issuer. And you can translate this embedded markup into embedded annual fee. The markups are mostly not disclosed because for most of my period, issuers didn't have to disclose what is the fair value of the security. And so this is also one of the reasons why researchers often struggle with observing what are the costs of the securities. I will be using near model free markup, which I developed in my previous work. So they are estimated either using Monte Carlo simulations or finite difference methods or static replication together with local volatility diffusions. I will be using standard pricing inputs. The most important input is the implied volatility of the underlying, which is going to come from option metrics. So to give you a better picture of what the investors may see when they are purchasing the security, here is a screenshot of a pricing supplement from EDGAR. Okay, so this is one of the pricing supplements that was registered with EDGAR. It's also very similar to the term sheet that the investors may see. And so for this particular security, the 2 headline rates, which I mentioned early on, the headline return, are mentioned both in the name of the security. So here, in the name, in the title of the security, the investors see that the security pays 10% per annum coupon. It's also repeated, this headline return is also repeated again in the prospectus very early on in bold font. And the second attribute, the second headline rate, the protection level, is also mentioned very early in the prospectus. It's again highlighted in bold, and so it's very visible to the investors. These are the only 2 attributes of the payoff shape that are actually quantified to the investors. The other attributes, such as the shape of the payoff diagram and what does it mean for the fee or the expected return, are described in a fine print in a fine print text, and so investors would need to process this text and understand what is the impact on the expected returns. So when you think about the choice of the investor, the decision the investor is making, the investor faces a menu of securities. I will now continue with the example security I showed you early on during my talk. So I call this security design plain vanilla because it's equivalent to a short position in a plain vanilla put option. And for this particular security, this plain vanilla design at the time of issuance offered a headline return of 10%, almost 10%, and protection level of 20%. Now in the same menu, the same issuer, the same bank offered a near identical substitute. So very similar security. It's linked to the same underlying asset, so the same underlying stock. However, now the design is not plain vanilla. It doesn't embed plain vanilla put option, but instead it embeds a short position in a barrier knock-in option. Okay, and so the engineering, the structuring of this knock-in barrier option is way cheaper for the bank. And as a result, the bank can offer more attractive headline rates. So almost twice as high headline return, 18%, and protection level of 35%. So really this mechanism of enhancement is not a substitution between securities of higher expected return and higher risk, but it's a substitution of different security designs. In this case, substitution to inferior security design. Inferior because in many states of the world, here denoted with the red arrows, the design pays lower cash flows to the investors. Okay, so in this case, if the underlying falls below the protection level, investors are going to receive back lower cash flows. This in turn allows the bank to increase the headline return in the best case scenario and also offer more attractive protection level.
Petra, if I may. So here I understand your argument, but it seems that inherently, to be talking about inferior design, you have to talk about the weight of those states of the world or the likelihood of those states of the world, right? Because if you're looking under the barrier that is kind of now at 35% rather than 20, on that part, this new product offers more. So if I were, to kind of try to defend the industry, I imagine I would say that maybe investors think that this is the region that is the most likely and are willing to kind of take the risk that this very, very unlikely crash risk is not going to materialize. What do you think about that?
Yeah, so I think there were two parts to your question. So like when I use the term inferior design, is this legitimate? Like I say inferior design conditional on having the same headline rate, so conditional on the protection level and the headline return being the same, then knock-in barrier design is inferior. So that's just to justify my language. Now, when it comes to the potential drivers of demand, okay, so you may think of some stories where investors have different probabilities of different states of the world. And so if you have an investor who overweights here the upside and underweights the downside, it may be rational to purchase the security. So the best response I have to stories like this is with my identification with the cost-based instrument and the falsification test. So some of these stories, this is going to take care of. Yes, I'm going to be using variation in the cost of structuring of the security together with this falsification test where these changes in the cost affect the headline rate or not. And I will show you that only when they affect the headline rate, this is exactly when they also increase demand. Okay, so that's the best response. But yes, your argument is valid. You may have some investors who have different probabilities. It would mean that these investors are on average wrong. That's one. Okay, because on average, when I look at realized returns are negative. So it would still have to be some bias of investors because on average, over my 10-year sample, investors got it wrong. Second argument is these investors would need to misweight these states of the world, and on top of it, not realize that they can get much better payoff through listed options. Okay, so we would still talk about some unsophisticated investors who do not realize that even if you misweight the different states of the world, you can go ahead and just write and buy listed puts and get payoff that is state-wise dominating. Does this answer your question?
It does. I'm sure I'm going to continue playing the devil's advocate a little bit later in the talk.
Yeah, okay, so let's wait for that. So when it comes to what the investors see with respect to this more complex, inferior security design, they see a fine print, so 3 paragraphs of fine print that describes the shape of the payoff diagram. Okay, so these 3 paragraphs basically describe that this security embeds the knock-in barrier option. So the breach of the protection level is evaluated on every single day. And if it's breached, investors participate in all the downside movement, not just below the protection level, but below the initial strike price. So if investors try to make sense of the impact of this different security designs, they first need to process these 3 paragraphs, and then they need to also value the embedded exotic option, okay, to understand what is the impact on fees and expected returns. So let me pause here a little bit to make clear what is exactly the mechanism of salient thinking I have in mind, because it's slightly different from what the early literature here considered. I can see that Neil unmuted himself. Do you want to ask a question or?
No, I'm just ready in case I do want to ask a question.
Okay, so let me continue. So the early generation of literature in this space, so the QJ paper by Boris and Vele, also talks about complexity. So they also focus on this additional fine print. And the story they have in mind, they do not have an exact formalization in the paper, but if you read the description and if you look at the empirical specification, they have a story in mind where complexity, these additional conditions, shroud risky features. Okay, so they compare securities with downside risk and without downside risk, and they find that the ones with downside risk are more complex, they have longer descriptions, they have more features. And so their empirical design would be consistent with a story where investors are sort of completely inattentive to the existence of downside risk. Okay, so this would be like a very high degree of naivete of investors. This is different from the mechanism I have in mind. So in my context, the way I formalize salient thinking about these salient attributes, my formalization is very similar to the formalization of Borel, Genoa, and Schleifer together with Gabet. And it's basically formalizing the notion that these attributes that are not quantified, such as the knock-in barrier option, because investors do not observe how much do these features affect the expected return or the fee, as a result, they are less elastic with respect to these features. Okay, so it's not a story where they would sort of completely disregard these features and wouldn't realize that these securities are risky. Instead, they are less elastic to these features as compared to the features that are saliently displayed.
Slow down. Could you go back? I heard the words you say, but I don't know how to understand. I don't see how to map the words you just said to equation 1. What are the two sets, P and H?
Okay, so P are prominent. So I'm using similar notation as to Bordello. So P are prominent. So these are just attributes that are visible. So in my context, this would be headline return protection level. H stands for hidden. So these are attributes that are less prominently displayed, so less visible to investors. In my context, this would be the impact of the knock-in barrier on expected return, for example, or the fair value of the security. Okay, and so here on top of the value of the attribute, which is AYK, and the weight the investors place on this attribute, which is pi here, you have also this MK, and that's an inattention parameter. Okay, so MK here is going to govern how inattentive, how sort of less elastic investors are with respect to attributes that are not prominently displayed. Okay. But for me, the most important message I want to get across is that I'm not trying to say that investors are completely clueless and do not understand these securities are risky. In fact, I think that investors do understand why these securities are risky, and that's why you see that banks make these protection levels attractive. I just have in mind a story where investors are less elastic to features they cannot quantify.
Can I ask a clarifying question on this too? So A would be the impact of your prevalent feature, which I guess is pretty straightforward to measure. But in the hidden set, then there are also hypotheses that you have to make to get to AIK, right? So in other words, the impact measure for the hidden features is less certain than for the prevalent features, is it not?
So you need to make some like reasonable assumptions, right? So you may, I mean, the same way as the bank has to quantify the fair value, or I am estimating the markup, you make some assumptions about what is the correct pricing model. That may be one. You may take the pricing inputs from the market. So we may want to assume that the market is sort of, correct, and that the pricing inputs you get from the market are valid. These are the only two features you need to derive the fair value. Okay, so if there are no more questions, let me get back to what the investor is, what is the investor's choice? How do I think about the investor's choice in this context? And what do I observe in the data? Okay, so if investors are contrasting these two securities, the plain vanilla design and the more complex one, they would need to do this, apply this option pricing exercise. So they would need to take some pricing model, take some pricing inputs, and quantify what is the impact of these additional features on the expected return or the fair value of the security. If they did that, they would see that the simple security is actually cheaper. They are both very expensive, so both charge around 9% in annual fees, but the simple security is actually cheaper. Yet what I observed in the data is that there were higher sales volume of the more complex security. Okay, so this would be consistent with the choice being more driven by these headline rates, an overweighting of these headline rates, as opposed to what is the fee of the security. Okay, so now to quantify what is the impact of enhancement in the whole data set, quantify what is the impact on demand, I will first measure the degree of headline enhancement. So how much do these additional conditions improve the salient attributes? And with that measure in hand, I will then be able to say something about how demand is sensitive to this enhancement. Okay. So for most securities in the data, I do not observe this plain vanilla substitute. So I do not have in the menu this plain vanilla security, as I showed you on the previous slide. However, I can construct the plain vanilla security because I observe the pricing input that the bank is facing. Okay, so for each security I have in the data, I fix all the attributes other than the headline return. So I take the same underlying, same maturity, I fix the protection level, so one of the two headline rates. I take the pricing inputs from option metrics, and I will quantify what would be the headline return offered by a plain vanilla design if it was offered on the same date by the same bank. And then the spread between the actual headline return of the security and the headline return that I get from the synthetic plain vanilla security is going to be my measure of enhancement. So my measure of enhancement quantifies what is the impact of the additional conditions on the offered headline return. The reason I can do this relatively easily is because for the plain vanilla design, I can just use closed form formulas for pricing plain vanilla options, and so I can very easily quantify what would be the headline return if the design of the security was simple and if the fee charged to the investor was the same. This allows me to quantify
what exercise. Sorry, in the previous slide, what's the protection level of the simple product?
Is the same as what the complex product. So I
Okay.
fix protection level. So this K here, the strike of the option on pricing comes from the protection level of the actual security. So protection level is fixed, and the headline return is the moving part.
Okay, so sorry, Will, since we're talking about this equation, just to be sure, so the fact that you're using the Black-Scholes formula here is because you're essentially using the Black-Scholes model around the implied volatility. Is that it?
For the quantification of the enhancement, yes. So for the quantification of the enhancement, I'm basically ignoring skew. So there is some simplification. Is that where you're heading, or? And so for the quantification of the enhancement, I assume constant volatility. That allows me to use just closed form.
Yeah, it's just I'm not 100% clear on whether the implied volatility that you would get from plain vanilla options would fully reflect, implied volatility being the wrong number that gives you the right price in the wrong model. It reflects all the misspecifications of the Black-Scholes model for these plain vanilla options, but I'm not sure it reflects the whole impact that some risk would have on a security that is more nonlinear.
Yeah. So so I'm using so for the plain vanilla, it is a linear security, right? So the impact is going to be smaller there. I agree that if you do take as an implied volatility, I take basically bilinearly interpolated implied vol from the volatility surface, there could be some error introduced. I don't think it's first order. In fact, I don't think it's even second order. I'm waiting for the referee to push me to estimate this using some more sophisticated methods. I don't think it's going to have any dramatic impact on the results, but it's true. Yes.
If the referees in the room, you definitely gave them ideas. Yeah. Thank you.
You could do this. You could do this cleaner. Totally. Yeah. Okay. So with this measure in hand, I can quantify what is the impact of the enhancement on the offered headline returns. Okay, so this is like one of the first novel results of my paper. We kind of knew that by increasing the downside risk, so what Feller and Walla show in their paper, by adding downside risk, it allows issuers to offer more attractive headline rates. Okay, and so the main mechanism there is really whether there is any downside risk or not. What I show in my context is that actually a large fraction of the headline returns does not come from whether the security has downside risk or not, because all my securities have downside risk. The first order manipulation in this market, how to achieve high headline returns, is because of these additional conditions. Okay, and so these may really be the main driver of these attractive headline rates in the market, as opposed to the distinction whether the security has exposes investors to downside risk or not. So out of the 13% average headline return in the data, 11 percentage points, so the vast majority, is because of these additional conditions. Okay, so this is the main driver of why these headline returns are attractive. Average protection level in the data is 26%. And so you can see that based on these two salient attributes, the headline return and protection level, these securities do look attractive. You will get on average 13% return per year, and you are going to be protected to 26% downside price movement in the underlying. This looks attractive in many pricing conditions. The reason this is not in reality so attractive is because large fraction of these attractive headline rates is achieved because of these additional conditions. Okay, so with this measure in hand, if there are no more questions, let me first say a few remarks about how does enhancement translate into return. So if you just regress realized returns, which I observe in my data, I can quantify them for the securities on headline enhancement, you will find that if anything, securities with higher enhancement pay lower returns. This is largely because securities with higher enhancement also charge higher fees, and higher fees are one of the major determinants of return in the market. So controlling for fees, I observe slight positive impact of enhancement on returns, but the magnitude is around 5%. Okay, so that would basically mean that 95% of the enhancements, 95% out of the 11 percentage points, do not translate into higher realized returns. Okay? This is also robust to using alternative measures of returns, so benchmark returns, which are delta hedge returns, or expected returns quantified under some expectation of the expected return of the underlying. You may also wonder, perhaps enhancement is lowering risk. This is not what I observe in the data. So if you look at the relationship between the standard deviation of the realized return with respect to enhancement, if anything, higher enhancement is associated with higher risk. All right, so this brings me to the main part of my test. And so I was a little bit more optimistic about the time. So I have 10 minutes remaining, correct?
Yes.
Yes, so I'm slower than what I
You
expected.
can run a few minutes over, but we have a hard stop at 20 minutes from now.
Okay, so my main empirical design is gonna regress the size of the issuance volume of the security, so logged volume, on this measure of enhancement, and then the fee of the embedded markup of the security, so the embedded annualized fee of the security. On top of that, I will use highly saturated regressions, controlling for other determinants of demand. I'm gonna have month fixed effect, maturity fixed effect, bank fixed effect, as well as underlying fixed effect. So underlying fixed effects are quite important. I'm going to basically take care of any kind of stories where investors have different sentiment for different underlyings that may be changing over time. So in my most saturated specification, I will have also interaction of these fixed effects. So I will have interaction of underlying times month. And so I'm going to take care of any kind of stories that involve sentiment, extrapolative beliefs, whatnot. On top of it, I will also include security design fixed effects. I'm going to be controlling for complexity. So my story cannot be driven by any stories where investors have either preference for complexity or complexity aversion, because I will keep complexity fixed. I will include fixed effects for security design. So this is going to be, for example, fixed effect for embedded Nokian barrier option, or fixed effect for embedded digital option. And so what I will be exploiting, what I will be left with, is going to be within security design variation and enhancement. Okay, so even if you control for security design fixed effect, there is a huge variation in how much does the Nokian barrier increase headline returns, depending on what is basically the vega, the sensitivity of the security design with respect to implied volatility. So this is going to be the main variation I'm going to be exploiting. Let me just quickly walk you through predictions of some investor preferences. If investors are mean variance investors, you would expect negative coefficient on the fees, on P here, because fees translate into lower returns. We wouldn't expect significant coefficient on enhancement, beta 1. If investors are Salient thinkers, you would still expect negative coefficient on fees, but on top of it, we would expect positive coefficient on enhancement because enhancement translates into more attractive Salient attributes. Okay,
So let me go back to the previous specification, right? So I think you just told us that the variation in X, that's enhancement, is driven by variation in implied volatility. Did I just hear you correctly?
Yes.
So do you need
Partially
to
driven, yeah.
assume, do you need to assume that volatility doesn't affect demand through, do you need to assume that volatility affects, that implied volatility affects demand only through enhancement?
So if you have in mind a story where volatility affects demand for other reasons than enhancement, then my best response is again my falsification test. So if there is some unobserved variable, do I understand your question correctly?
Yes.
Yes. If there is some unobserved variable that is going to correlate with implied volatility, and it's going to be correlated with demand for enhancement or like demand for security designs which have higher vega for some unobserved reason, then my best response is the falsification test. Yes. Okay.
Okay.
So that I manage to show you the falsification test in the 17 minutes I have. Let me walk you through the estimation. So again, when it comes to the coefficient on fees, I do find that demand is fee elastic, so the coefficient is negative. So the higher the fee, the higher the embedded fee, the lower is the issuance volume of the security. On top of that, I find also statistically significant sensitivity with respect to enhancement in terms of magnitude. The size of the coefficient is about half of the size with respect to fees. And because both of these measures are expressed as annual percentage rate, the coefficients are comparable. Okay, so based on my estimate, demand is about half sensitive to enhancement as it is with respect to fees.
So one thing I'm very interested in, right? So there's another number that's interesting, right? So demand based on these coefficients is more sensitive to fee than to enhancement. But what's the elasticity of enhancement with respect to fee, right? This is, so if you take $1 out of fees, how much you reduce demand directly, but if you take $1, you know, or if you add whatever, you change fees, you reduce fees by $1 and increase enhancement by $1, right? I think maybe you understand what I'm getting at. If you switch money out of fees and use it to increase enhancement, what's the net effect?
So I don't have the number for you. It's gonna be more than 1. So if you lower fees by 1%, you are gonna increase, sorry, enhancement. So the sensitivity of coupon with respect to fee is more than 1. Sensitivity of enhancement with respect to fee, I don't know actually the number, and I cannot back it out from the estimates I have. So I will need to get you that number. So you are thinking of a story where it helps with the economic interpretation of these coefficients. Do I understand correctly?
Well, I'm actually thinking about, are the estimates consistent with optimal behavior by the issuer, but it also depends upon, well, I'm not sure what I'm thinking about. I was vaguely thinking about whether these estimates are consistent with optimal behavior by the issuer, right? That there ought to be an equilibrium in which the investor can't further increase the embedded fee, the total embedded fee, but it's not clear you can really get at it this way. Anyway.
So I'm not sure, can you get that out of these estimates? I mean, these estimates are averages. So let me think about it. Yeah, I'm not sure, can you learn from...
You need to move on anyway, sorry.
Yeah, let me think about it. Let me show you some graphical evidence which may make it clear why it's not obvious whether you can interpret these averages as evidence consistent with optimal behavior. Okay, so this estimation is robust to many things. I will try to show you the cost-based instrument today if I have time, but there are other robustness checks I do in the paper. So the one thing I wanted to show you when it comes to the interpretation is the graphical evidence. I find that the relationship is concave. So the relationship between demand and enhancement becomes flat at high levels of enhancement. Consistent, so on one hand, explaining why we don't observe even higher degree of enhancement in the market, and it's also consistent with some of the formalizations of Salient thinking, where enhancement should be more, enhancement should play more, should have more impact on demand at low levels as opposed to high levels. So I don't know how, when it comes to interpreting the coefficients, how do you make sense of it if the relationship is not exactly linear, but it's concave? Because what I showed you in the previous regression is obviously just one number, one average. I find that the relationship is concave with respect to both of these headline rates, so both headline return and protection levels. So again, this is consistent with investors actually understanding that there is a downside risk and being sensitive to the level of protection level and demanding both attractive headline return and protection level. So in the last 12 minutes, let me just sketch what is the instrument achieving and what is the falsification test achieving. So far I controlled for all product attributes. That's useful, but as Christian mentioned, or as Neil mentioned, there may be some other stories. So there may be story of different state probabilities. There may be stories of demand being, for whatever reason, correlated with enhancement. You may also have stories where the market is segmented, there are heterogeneous investors, and for whatever reason, these segments of the market, the size of these segments correlate with enhancement or whatnot. So you may basically worry about omitted variable bias. So my solution is to instrument for enhancement using the structuring code. So it really exploits the different sensitivity of these security designs with respect to implied volatility. So for example, increasing implied volatility for a plain vanilla design gives you some increase in the coupon rate. Increasing volatility for knock-in barrier design gives you a higher increase in the coupon rate you can offer. So the knock-in design has a higher vega. I estimate vega from the data, and then I multiply it by the implied volatility of the underlying. So this is the identifying variation I'm going to be using. Cross-security design in vega, and then time series cross-sectional variation and implied volatility of the underlying. There is no issue with the relevance of this instrument for the first stage. This is a super strong instrument. I find that when banks face changes in the pricing conditions and the implied volatility of the underlying increases, they do translate that into higher coupon rate, high protection levels for the investors. So there is very strong first stage. The concern is about the validity. Okay, so this is also maybe partially reflecting one of the questions by Neil. So if there is some variation in demand that shows up in higher demand for securities with higher enhancement, at the same time, it increases the implied volatility of the underlying, because some of that demand investors may demand listed options and may affect the prices of listed options, then you may worry about the exclusion restriction. Okay, so you may think about demand shock that at the same time affect demand for high enhancement structured products as well as implied volatility of the underlying. So my best response is this falsification test that exploits this period when the headline rates of the security is fixed. So the way you can think about the offering process is some design period when the bank picks the security design, they pick the underlying security, the maturity, and they also at the end of this design period pick the headline rate. So they will select what is going to be the headline return and the protection level. Then there is a few-week period when these securities are offered by brokers to investors. So if there is a change in the pricing conditions over this period, it doesn't affect the headline returns. It cannot, because these headline returns and protection levels are fixed. However, it can still affect demand, because over this offering period, investors can decide how much of the security they want to subscribe. At the end of the offering period, there is a fully elastic supply, so the bank is going to issue all the subscribed amount. Okay, so under my story, any pricing shocks to the bank should translate into higher demand only if these shocks occur during the design period, because this is when they also translate into the higher headline returns, but they shouldn't translate into higher demand when they occur during the offering period, because this is when the headline rates are fixed. And this is exactly what I find. So if I alter my demand elasticity regression. So again, regressing logged volume on fees, saturated fixed effect, but now I decompose the enhancement, the instrumented enhancement to the level of the pricing conditions 1 month before the start of the offering period, the change in the pricing conditions over the design period, and the change over the offering period. I find that demand is sensitive only to the changes that occurred during the period when they also translate into higher headline rates. And so this would be consistent with my mechanism that the only variation in implied volatility affects demand only when it also affects headline rates, but not when not. And I'm really eager to hear the question.
I don't remember your notation here. Phi is the product of vega and implied volatility.
Yeah, so that's the structuring cost. Yeah.
Okay.
So the first one is going to be the level. The second one is the change over design period. The third one is change over the offering period. So the two changes, they're both in changes. Okay, so I'm comparing changes and changes just over different periods. So what would be a big problem for the validity of the instrument if beta H3 was positive significant? That would be consistent with the story that some other unobserved demand shocks are spuriously, correlated with enhancement, and they are also affecting implied volatility. All right, so I'm running 3 minutes over my time, so I will skip the section on the mechanisms where I have some evidence consistent both with the prominence channel and the contrast channel. I can talk more about it if there is demand during the Q&A. So let me conclude by going back to the interpretation. I interpret these results as most consistent with investor salient thinking, whereby they overweight the salient attributes. This also explains why banks are engineering attractive salient attributes. You may think of some other stories. You may think of stories of reaching for yield or reaching for income, whether behavioral or some other stories. Those may explain some part of the result, wouldn't explain why banks also enhance protection levels. Okay, so my story is a bit more nuanced. It has to be a story where investors like both high headline returns and high protection levels. You may also think about some stories such as hedging. These would be, again, inconsistent with my elasticity estimate. Wouldn't explain why investors are buying these securities despite being statewide dominated by listed options. Conflicted brokers can explain why investors buy these securities despite being dominated by listed options, because these securities pay huge commissions to the brokers, but wouldn't explain other results. So I will argue that the most parsimonious explanation, the most useful way how to think about this market is through the lens of salient thinking. And the last thing I will mention is that I do not take any strong stand on welfare. I cannot. But to give you a flavor of what may be the welfare implications, if we lower enhancement by 1 standard deviation, based on my estimate, this would save investors 1 billion in fees. Thank you so much, and I'm happy to take more questions.
Okay, so at this point, I guess anyone who wants to is free to unmute yourself and use your microphone to ask a question or tell Petra she's wrong or say whatever else you might want to say.
I just have a quick question. So it seems that the enhancement and the fees, they're like very tied to each other. So my question is, like, what's the correlation amongst them, and if you should orthogonalize one to the other when running your regressions?
So I don't have the correlation. They are correlated. So fee and enhancement, they are correlated. I have one table in the paper that shows that fees increase with enhancement. So the higher enhancement, the higher the fees. Should I orthogonalize? That was the question.
Yeah.
So what would that give me?
Well, that if the correlation is very high, basically you don't want to run the correlation with those two variables in the same regression.
So I understand I would worry about it if there is some kind of multicollinearity issue.
Yeah.
So I for those reasons I could, yeah. So if you worry about multicollinearity, that I could rule out with orthogonalizing them. Yes.
Yeah, and I was also like, along with what Neil's comment, that you should include the interaction between fee and enhancement in the regression. And as just like him, I'm not sure what that's gonna give you, but I was thinking as you were presenting, I was like, okay, what are the interaction? And maybe it's because I find it important because if they're correlated, the question is whether that interaction adds anything else to the model.
So I haven't tried that. I haven't thought about interacting. I'm thinking, how do I interpret interaction of fee and enhancement? So through the lens of my model, my formalization, that coefficient doesn't have any obvious interpretation. I understood Neil's question more in line of how do we think about the economic magnitudes of these coefficients?
Yes, Morgan Stanley is trying to maximize fees, or really percentage fee times volume, right? Are the coefficients consistent with that? But anyway.
Yeah, that's something I should think about. Can I say something about optimal behavior of banks? Yes.
Thanks.
Thank you.
Other questions? Last chance.
Well, it seems that Petra was super clear about structured products. This is an interesting market. I really enjoyed your presentation, Petra. Thank you so much for being with us today. Thank you everyone for joining us after this long break. Now the next VDW is going to be in 2 short weeks, wherein Chris Jacobs is going to be speaking. So on that note, thank you very much once again, and see you again in 2 weeks.
Thanks a lot. Thanks a lot again.